Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets across the Asia Pacific are slumping on the final trading day of the week. In South Korea, the Kospi is on track for a weekly loss of about 3%. Earlier in the States, equities sold off for the second time in 3 days. A lot of concern over valuations. That's become a major factor. And that's where we started the conversation with Pruksa Iamthongthong of Aberdeen Investments. She spoke with Bloomberg TV host Yvonne and David Ingles.
This is coming at a time when people are really questioning the valuations of some of these sort of AI tech darlings that really outperform for much of this year. What has Aberdeen been doing in the face of all this volatility now?
Yes, so we have been looking at the current earnings seasons very carefully, and as you can imagine, we are in the midst of the tech earnings seasons, both for the key suppliers like Taiwan, Korea, which reported over the last 2 weeks, as well as for the US hyperscalers. And I think the summary of all the results have basically shown that things are still looking pretty robust from a fundamental perspective. And I think the key takeaway is that where we are today, we are getting increasing visibility about the growth in 2026. So actually, all the signs from a fundamental perspective is pointing to a stronger year in 2026. I think what's not very clear is about how will 2027 shape like, and the valuations have run ahead. So I think from our perspective, given how fast the market have run, there might be a little bit of a hiccup. I wouldn't be surprised with regard to that, but we will see this as a long-term buying opportunity because we do think fundamentals are still stacking up.
You mentioned some of the AI supply chain markets like Korea and Taiwan. People seem to be looking at AI valuations, and there seem to be only, and I think it's erroneous, just very extreme versions of it, right? It's either you're in a bubble or you're completely depressed. How would you describe valuations? Do you see room for compression? And might be a separate question. Do you think they're overvalued? Which is a somewhat separate question to the first one.
We don't think they are overvalued. We do think they are probably at the fairer stage than they were at the start of the year, especially when you look back, at the Liberation Day, that was a big sell-off under a very different circumstance. So we do think that as long as fundamentals continue to grow and that remains supportive, we should continue to see valuations go up. I think there is a bit of a discrepancy between where valuations of tech companies in Asia and in China are at versus, say, the tech companies in the US are at. And I think from an Asia point of view, the relative valuation that we are having today does give a bit of a buffer while fundamentals remain quite strong. So you can tell that we are on the positive side of the trade.
Okay, in terms of how to play and position around the AI theme now, what's sort of the advice to clients?
From our perspective, we do have quite a good position on a broader perspective. So you have the semiconductor supply chain, which plays into the infrastructure layer. We look at the application layer, which people might have forgotten, but China Internet is actually one of the main players and the key drivers within the application layer, which we do think that the ability to monetize what they have invest in the infrastructure layer is actually very strong. You have the broader ecosystem, which you talk about, nowadays you are starting to see that power is the real bottleneck as well, and you have the power equipment supply chain, you have the energy storage system that will be part of the power equipment. So we really look at things from a broader perspective rather than just the actual tech sector as a whole.
And outside of that, are those still going to deliver the alpha in China? I mean, is it time to be looking at cyclicals, or are you not seeing that in the data just yet?
I think we are not really seeing that in the data just yet, but it's actually looking pretty interesting. And I think this is really because on the cyclical front, activities have been quite slow, and understandably so, given where the tariff situation have been at. Today we are getting more clarity than before, and what that means is that as a business and the companies that we talk to on this trip as well, they are looking to continue to their plan, and it's business as usual, right? Once you have the tariff in place, you now know how to plan your supply chain, and therefore you will continue to diversify out China.
Tell us about the trip. So what's the sense you're getting from this as you meet clients and companies?
Yes, so I was in Shanghai and Suzhou earlier during the week.
Interesting picks, okay.
Yes, meeting the team, but also meeting some of the companies there, and it's a variety of companies. But I think generally what the companies have been seeing are more on the AI and semiconductor side. And what they are saying continues to be very much what we have observed in the overall market, which is demand remains to be pretty strong. Some are in short supply, and therefore they have to make prepayments. And I think that very much is a good sign with regard to how tight the supply chain is, right? And those are the broader, data points that you don't get unless you start visiting the companies and then you start talking about them, about all the softer data points.
I was going to ask you about what we saw. I mean, you started to see maybe, as you mentioned, China still offers those AI opportunities. Coming at a time when I'm looking at a market like Korea, where volatility is picking up, and massive sell-off in some of these really big names that have done so well, and in contrast, China actually has been seeing volatility head lower. What do these dynamics tell you about where best to kind of position and kind of hunker down as we count down to this year?
I think it still comes back to fundamentals, because what you have described is really just about a rotation in the market from things that have gone up and is looking slightly more expensive to where things that have been sold off and perhaps have been not looked very closely, like I think China volatility has come down, but from a very high base.
Yeah, you still favor Korea though.
We still favor Korea, and within Korea, I think it's not just about the tech trade in Korea.
Okay.
We have the value up trade that has been, I think, not talked about much because of the excitement surrounding tech, but I think if you look at the Korean financials, the insurance companies, or even the cyclical like the shipbuilding companies, they are all really willing to come up with measures to improve shareholders' return as part of the overall government campaign to really increase their dividend payment. So I think we do see quite a big change there, and we are excited about the value up opportunities in Korea in addition to the tech opportunities.
Last question for you. Southeast Asia, what's pretty there going into next year?
Southeast Asia, I think what's pretty is the valuation. Again, a forgotten region. I'm from Thailand, and Thailand has been one of the weakest performing markets for quite a long period of time until we have a change in government. I think what you see with Southeast Asia is that the positive side of things, you have pretty good rates cut backdrop that is going to stimulate the economic growth. And with that, you have the government stepping in various countries like Indonesia or Thailand to really drive on the fiscal front to stimulate the economic growth. So we do think things are looking pretty attractive, and growth is coming back, supported by the government.
That's Pruksa Iamthongthong of Aberdeen Investments, speaking with Bloomberg TV host Yvonne Mann and David Ingles, bringing it to you here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Shareholders in Tesla approved a $1 trillion compensation package for CEO Elon Musk. More than 75% of the votes were cast in favor. Now, this clears the path for Musk to expand his stake in Tesla to 25% over the next decade. Here is Bloomberg's Ed Ludlow.
For Elon Musk, this was about having more voting power and voting control. And for those institutional investors that voted no, they were worried about concentration of voting power that he had and dilution for them. In the end, voters have overwhelmingly come out, 75% of them or more, and said, we're happy to hand over more control to Elon Musk and keep him in the driver's seat to realize these longer-term goals in robotics and autonomous driving.
That was Bloomberg's Ed Ludlow. Now, to achieve this full payout, Musk must deliver on targets to significantly expand Tesla's market value. He must also revive Tesla's car business and get the company's robotaxi and robotics efforts off the ground. In the regular session, Tesla shares were down 3.5%. on a day when U.S. equities sold off for the second time in 3 days. For a look at the market action, I'm joined by Clark Garanan. He is the chief market strategist at CalBay Investments. Clark is on the line from the Bay Area of California. Thank you so much for making time to chat with me. A little bit of a pullback today in equities. There's some concern. It shouldn't be a surprise to you that valuations are stretched, especially when we're talking AI. And perhaps more worrisome for the market is the fact that breadth has been narrowing. Are you still constructive on stocks?
I am still constructive on stocks. You know, we have seen sort of this pullback over the past couple of weeks, and really we've seen the sharp spike in the VIX. But I'm really not too concerned. We have been bullish really since April, and having seen the tariffs not really have the impact that we thought they would. I think a lot of it right now comes down to some of the headline risk with unemployment numbers and the government shutdown. So that seems to be kind of playing a part in all of this with the AI bubble. And talk about the AI bubble. I mean, we've still been really constructive on earnings and where we're going. We're really not even that concerned about unemployment at this point. So overall, yeah, I'd say we are.
So you mentioned the April low. I think we're up around 36% from that low if you look at the S&P 500. That seems like a pretty big move, and I would imagine statistically that a pullback, maybe of a magnitude between 10 to 15%, would not be out of the question.
And I would say that maybe between 5 and 10% could be where we potentially go. And honestly, kind of wasn't expecting that until the beginning of the year. We just thought that there was still some more room to run towards the end of the year with rate cuts and just our seasonality in November and December. Typically, we're going to see at least, 4 to 5% on the positive side. Whereas now we've had rate cuts and the market's just been really trading sideways. And so I think some of it is just this fear of, like you mentioned, the 36% up since April. And I think some of it's also just social too, where you hear about Michael Burry coming out with his puts on specific companies. And I think that just kind of adds fuel to the fire. And so that combined with a lack of data that we're seeing due to the government shutdown, I think it kind of puts us back in that little side of worry where, hey, we don't really know where we're at with inflation and unemployment. And so now we have to really lean on some of the private data, which, typically just makes investors feel a little bit nervous. And I think that's why we've seen the VIX run up.
Yeah, well, I'm glad you mentioned that. We had the data from Challenger Gray and Christmas today on October job cuts, 153,000, a little more actually, nearly triple the number during the same month last year. Now, you mentioned the AI trade. We can get back to that in a moment. But in terms of what the data may suggest about the Fed and what it does next, today's Fed speak was a little hawkish. The head of the Cleveland Fed, Beth Hammack, was saying that inflation is a bigger risk than job weakness. And we heard from Austin Goolsbee, the head of the Chicago Fed, and he was telling CNBC the lack of inflation data during the shutdown makes him a little bit uneasy when it comes to talking about rate cuts. I thought it was very interesting. If you look at what was happening in money markets yesterday, the odds of a December rate cut were probably around 70%. Today, that moved down to around 60%. Again, inflation seems to be the bigger worry at this point, and I'm wondering whether you feel the same way.
I think I do. And it's flip-flopped over the past 6 months where obviously with the tariffs, the main concern was going to be inflation. But over the past few months, we've really seen it kind of hold tight right around 3. And I think that is part of the reason why we've seen the markets just flourish. And then kind of shifted more towards the unemployment numbers as that being the concern. Okay, tariffs are off the table, inflation's off the table. Now we got to look at unemployment. And then I think it was last week or 2 weeks ago when Amazon came out and said that they're going to be laying off 30,000 more white collar kind of, middle management level jobs, that I think that kind of sparked everyone's main concern. Meantime, we're not getting any updates on unemployment numbers. And so that was the main concern. But now after hearing some of the Fed governors talk today, that they're flipping back to inflation. We're really not worried about the unemployment side. And honestly, we don't think that we need another rate cut. So we'd be in the camp of saying, yeah, let's go ahead and pause at the end of the year, reevaluate once we have additional numbers. So I think inflation is probably our main point of target right now as opposed to the unemployment.
So have you been surprised by the apparent resilience of the American economy so far this year?
Yes. And I think that always stands is just going back to the consumer. You know, the consumer makes up 2/3 of our GDP. And while some people say, don't fight the Fed, I think it's also true, don't fight the consumer. And when we see the consumer continue to spend like they have been, not necessarily in a reckless manner, but seeing that continue has been just great to see, especially from somebody who's in the industry is just making sure that people are still continuing to spend. And, our clients haven't had an issue with that. And it's really a key driver of the economy. Mm-hmm. So making sure that people are still able to spend, making sure wage inflation is still staying above price inflation. I think those are really important for us as just a society and as well as the GDP.
Well, I'm glad you mentioned the consumer, Clark, because Bloomberg data show the richest 10% of households are fueling nearly half of total U.S. spending. Yes, that's largely due to the wealth effect. We know that the stock market has been surging the last few days, kind of put aside for a moment. But if there is a more substantial pullback, let's say, in stocks, and the richer households in the economy kind of curtail their spending, might that not set us up for maybe a little bit of a downturn in the economy? I won't say recession, but certainly much more in the way of weakness?
Sure. I think that's always the case, is that I think, like you mentioned, we've seen that number of top 10%. It moved from 40% of the spending, I think 10 years ago, now to 50% of the spending. And obviously that's not a great trend. And the hard part is, how do we fix that as a society? And so I think that's kind of always a risk that's on the table. Moving into next year, if we do see a pullback within equities, does that mean the high-end consumer will stop spending at the same clip? Maybe, but at the same time, I'm also really hoping that we see mortgage rates continue to come down. So that would be a case for additional cuts, just so that we can see the housing market start to move around again, because I know that's going to have an impact on both the high-end earner as well as the low-end earner.
So let's get back to AI, as I promised. And you mentioned Michael Burry's move earlier in the week. He spent more than $1 billion to buy some put options on both Nvidia and Peloton. You're in the Bay Area. Tell me what the conversation is like where you are when it comes to artificial intelligence, and whether people are perhaps a little concerned that things have become maybe a little extended.
I do think that a lot of people have, expressed the fact that they think some things are extended. I've seen that even with clients. I had one client that actually placed a trade in a high-end AI name last week and already decided to jump out of the position this week. And I think that kind of shows some of the greed and fear that we're seeing in the markets right now. And so I think there was a lot of FOMO, or the fear of missing out, for many clients, where they decide to jump in and then they see a pullback and everybody just starts to pile on and pull back based off of some of what you see in the news. Like, you hear about the Michael Burry position. And to be honest, with that position after it came out, I believe that those were actually placed a few months ago. And so for all we know, those could already be closed out. So it's just interesting how, stories like that can be put around and can have such an impact on just our general emotions, as we see fear and greed just play into this year, especially, so much.
Clark, we'll leave it there. Thank you so very much. Clark Garanon is the chief market strategist at CalBay Investments, joining from the Bay Area of California here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.